Welcome to Capital Allocation Lab. I'm Alex.
And I'm Maya. This channel is really an audio-first library for long-term, fundamentals-minded investors. Our whole mission is to take these classic, enduring ideas from finance, the books and concepts that really matter, and translate them directly into usable decisions that you can apply in your portfolio today.
Yeah, exactly. If your main focus is on owning high-quality businesses for the long haul, rather than, say, constantly checking the latest stock quotes or chasing daily headlines, you are absolutely in the right place. We're here to uncover the crucial lessons that just stay true, regardless of the current market cycle or what the economic climate looks like.
And today we are doing what is, I think, arguably the most important deep dive in our library. We are focusing on Chapter 20 of Benjamin Graham's classic work, The Intelligent Investor.
Right, the big one.
The big one. This is the chapter Graham himself said was the central concept of investment, the concept of the margin of safety. If you only internalize one single idea from his entire philosophy, this is it. This is the one to hold on to.
Okay, so before we jump into the mechanics of this, just a quick request. If you find these calm, long-horizon lessons helpful, and these are lessons really designed to help you avoid those catastrophic, life-altering mistakes, please subscribe to Capital Allocation Lab and tap the like button.
It's really the simplest and most effective way to support the educational work we're doing and make sure these lessons can reach more long-term owners.
And as we unpack this, we really want you to listen actively. Think about how this idea, this margin of safety, applies, or maybe fails to apply, to the things in your own portfolio.
Yeah, start thinking about questions or real-world examples. We'd love for you to drop those in the comments when you're done listening.
All right. So let's frame the core mission for today. Graham's philosophy is, it's deeply counterintuitive to how a lot of people think about markets, and it really boils down to this one premise. We are going to discuss in detail why the discipline of not losing money is mathematically, behaviorally, and philosophically even more important than the pursuit of making money.
It's a huge shift in perspective, and it all starts with redefining risk. If you're coming from the world of trading or speculating, you have to completely change how you think. I mean, when most market commentators talk about risk, they're almost always talking about things like volatility, the stock price bouncing around 5% in a week, or market drops, temporary corrections.
But Graham forces you to think like an owner of the entire business, not just a little piece of paper. And for that real owner, the definition of risk is just so much simpler and, frankly, more important.
It is. For Graham, risk is simply the chance of permanent loss of capital. That's it.
Full stop. Volatility is just noise. Permanent loss is a total failure of your strategy.
Exactly. And to have the patience to ride out that volatility, Graham gives this wonderful historical analogy. He tells the story of a king who asked his wise men to find him a single sentence, maybe 4 words, that would always be true, whether he was experiencing incredible fortune or just total devastation.
And after thinking about it for a long time, they came back with that simple phrase, "This too shall pass."
And that applies perfectly to every single market cycle that has ever existed and every one that ever will. Booms pass.
Let's pass.
Periods of crazy low interest rates pass. High inflation passes. The #1 job of the intelligent investor, the capital allocator, is just survival.
You have to structure everything to guarantee that when the hard times come, and they always come, your capital is still standing, ready to benefit from the next upcycle.
And that leads us right to the how. How do you survive? Well, that is the function of the margin of safety. It is by definition that cushion, that buffer you insist on having between the price you pay for an asset and a conservative estimate of what it's actually worth.
Even under bad conditions, it's the room you build in for being wrong.
And the consequences of ignoring that cushion are just. They're brutal. And the math really makes the case here. Let's use that simple example of 2 investors. Both start with $10,000.
Okay, so investor A is our defensive investor. They just buy a broad index, a quality portfolio, and earn a modest, consistent 5% a year. No drama, just quiet compounding.
Right. Now, investor B, this investor gets swept up in some market mania, a hot story, and they massively overpay for their first investment. The market corrects, and in year 1, their $10,000 is cut in half. They're left with $5,000.
But here's the interesting part of the setup. After that huge loss, Investor B's company turns out to be brilliant. It starts growing at 10% a year, which is double Investor A's rate.
Yeah, and here's the punchline. It just reveals the devastating cost of ignoring that initial margin of safety. Even with that much higher growth rate, that 10% a year, it takes Investor B Well, it takes well over a decade and a half,
A decade and a half.
17, maybe 18 years, just to catch up to the capital that investor A built with their slow and steady 5%.
17 years, that's the compounding you can never, ever get back. I mean, falling into a 50% hole is actually pretty easy if you ignore price. Oh, it's so easy. Climbing out, though, takes years. And you lose the base that all your future growth compounds on. The shadow of that first mistake is just incredibly long.
And this isn't just a thought experiment. We saw this in the dot-com bust and again in, parts of the 2021 speculative boom. Some stocks fell 80, 90%. If you bought at the peak, even if the company was great and grew at a 10 or 15% after that, you, the investor, would need maybe 25 or 30 years just to get your money back.
That's why Graham insists on the margin of safety. It's a mathematical decision to not even put yourself in that hole in the first place. It's the discipline to say, great story, but the price is terrible and the downside math is unacceptable.
And a key point here is that this isn't about prediction. It's protection.
Exactly. You don't need to know when the next recession is. You use a margin of safety precisely because you admit you don't know the future, so you have to build a shield against your own mistakes.
So let's start where Graham did. Let's see how this idea works in the world of fixed income, in bonds. Right. It's important to remember he started his career looking at bonds, especially for things like railroads and utilities. And for a bondholder, it's all about one thing: avoiding default, survival.
That's their only measure of safety.
It is. So he came up with a very clear quantitative test. He said an intelligent investor should only buy a corporate bond if the company's earnings, and this is key, looked at over several years, not just one good quarter, have consistently covered their fixed interest payments by a comfortable margin.
Which is where we get the interest coverage test, which, credit analysts still use every day.
They do. Let's use this example. A company has an annual interest bill of, say, $10 million. Graham would insist that over a full business cycle, its average pre-tax earnings should have been more than $50 million.
So a coverage ratio of about 5 times.
Exactly. And you have to ask, why so high? Well, it's protection. If a bad recession hits, and one always does, and earnings get cut in half, from $50 million down to $25,
right,
well, the company can still easily pay its $10 million interest bill.
The margin of safety is that huge buffer. It's the $40 million of earnings left over in an average year.
Right. That's the cushion.
So that raises a practical question for today. Graham used 5x coverage as his benchmark, but now you see a lot of investment-grade bonds from companies with lower ratios, maybe 3x or 4x. Is that 5x rule still realistic, or is it more about the concept?
That's a great question, and it's all about translating the principle. The principle is absolute. You need a wide margin. The 5x number itself was let's say, a product of its time, a very unstable time. Today, you have to adjust.
Yeah.
But the moment you start accepting, say, a 2x coverage ratio, you basically eliminated your margin of safety. A 50% drop in earnings, which is not unusual in a recession, puts you in immediate danger. So while 5x might be tough to find, aiming for 4x or higher is still critical. The principle of insisting on a big cushion is what matters.
So the number's cyclical, but the idea of a proportional cushion is constant. And he applied this to assets, too, not just earnings.
Exactly. You can have a margin of safety based on liquidation value. Say a business has tangible assets factories, inventory conservatively valued at $30 million, but it only owes $10 million in debt.
That $20 million excess is the margin.
Right. Even if the value of the business gets hammered and falls by 2/3 down to $10 million, the bondholders are, in theory, still fully covered.
This really shows how conservative he was. He wasn't trying to predict a great future. He was just assuming the future wouldn't be dramatically worse than a conservative version of the past.
Yeah, the margin is just the room for being wrong. It makes a precise forecast unnecessary, which is why he said it's the secret of successful investing. You protect against the future, you don't forecast it.
So the big leap is taking this idea from the fixed world of bonds and applying it to the, totally variable world of common stocks. Can you really do that?
Graham insisted you can, and you must. You just have to stop thinking of a stock as a ticker symbol and start treating it as what it is, an ownership share in a real, quantifiable business.
So how does this margin actually show up when the returns aren't guaranteed? Where do you find that cushion?
Well, you can start with the ideal, the extreme bargain. This is the famous net-net idea. Imagine a solid, debt-free company. It could easily go out and issue, say, $10 million of high-quality bonds.
Okay.
But because of a market panic, the entire company, all of its stock, is trading on the exchange for just $8 million.
Wow. So you're literally buying the whole business for less than the amount of safe debt it could support.
Exactly. In that very rare scenario, the common shareholders get bond-like safety because their price is backed by hard assets, plus they get all the unlimited upside of being owners. This was Graham's bread and butter after the Great Depression.
Why are those so rare today? I mean, it must take incredible discipline to buy them. I'm guessing they are not glamorous businesses?
Not at all. They're usually in distressed, declining, or just plain confusing industries. And they're rare because, one, markets are just more efficient at pricing simple asset value now, though you can still find them in tiny microcap stocks.
And the second reason?
The behavioral barrier is huge. By the time a company trades below its liquidation value, the headlines are awful, it's probably losing money, and everyone is calling it a value trap. It takes real, unwavering conviction in the arithmetic to buy what everyone else thinks is toxic.
Okay, so that's the ideal. But what about the typical scenario? What can most of us actually find in a normal market?
Usually the margin comes from buying earnings at a yield that is meaningfully higher than the rate you can get on a high-quality bond. The cushion is that excess earning power.
Let's run the numbers on that to make it really clear. Let's say a high-quality bond is yielding 4%, and an investor finds a stable, good business that they can buy for 11 times its normal earnings.
Right. 11 times earnings is an earnings yield of about 9%. So let's break down that difference. For every $100 you invest, the business earns $9.
And let's say the company pays out 4 of those dollars as a dividend, which, matches the bond yield. The other $5, that's retained and reinvested back into the business.
That excess 5% yield compared to the bond rate, that is your quantifiable margin of safety. And think about the power of that. Over a decade, that 5% reinvested every year adds up to 50% of what you originally paid. You've built a massive statistical buffer.
Okay, but here's a question I think a lot of people have. If the company only pays me $4 and keeps the other $5, how do I actually get the benefit of that $5 margin? Doesn't the stock price have to go up?
That's a great question, and it gets to the heart of long-term capital allocation. You benefit in 2 ways. First, that retained $5 increases the book value, the capital base, the future earning power of the company. So even if the PE multiple never changes, the earnings per share grows, and that slowly pulls the stock price up with it.
I see.
And second, by insisting on buying at 11x earnings, you've ensured you are not relying on the market getting more optimistic. The margin is built into the cash flow itself. You get paid through the growth of the business's intrinsic value, not just a change in market sentiment.
And for this to work, Graham had 2 really critical conditions. First, that 9% earnings yield has to be based on normal earnings, not a one-time peak. You have to be really tough and scrub the numbers.
And the second condition is diversification. You have to spread your bets across a group of these kinds of stocks. If you do that, Graham's conclusion is, well, it's very humbling. You don't need to be a genius. Time and normal economic growth will take care of your returns.
And the opposite is the danger you see in bull markets. If bonds yield 4%, but popular stocks are trading at 30x earnings, that's a 3.3% yield, you're taking on all the risk of owning a stock without any of the extra compensation.
Your numerical cushion is gone. You're just hoping that earnings will grow incredibly fast for a very long time and that the multiple will stay sky high. That's speculation.
So the key takeaway is that margin of safety in stocks is about 2 things. Quality plus price, you need that gap.
Absolutely. The same wonderful business is a bargain at one price and pure speculation at another. The value is totally dependent on the price you pay.
This leads right into what Graham called fair weather investments. These are things that look safe when the sun is shining, but are actually really weak underneath.
Right. And he warned that the biggest, most catastrophic losses don't usually come from, slightly overpaying for a great blue chip company. The real portfolio disasters come from low-quality stuff that just successfully pretends to be safe during a boom.
Historically, that was things like shaky bonds or stocks of obscure companies that had one good year. In a boom, everything sells. Everything looks good.
The earnings are strong, the dividends are flowing, the marketing is slick.
So what does a fair weather investment look like today in 2024?
Well, it's the same idea, just a new packaging. It could be a super leveraged company that only works because interest rates were 0. The second rates go up, the business model breaks.
Or a tech company losing tons of money but priced at 80 times sales, just based on a big story about its potential market.
Exactly. Or think about the SPAC boom. These were complex, untested vehicles that looked amazing in 2021 when money was basically free. But they collapsed when the real test, the need to generate actual cash flow, finally arrived.
So the danger is the same. In good times, nobody notices the lack of a cushion because current performance looks great.
Precisely. Graham's test is relentless. The true measure of safety isn't how it does in the sunshine, but how it behaves in a storm. And for that, you can't just look at the last glossy earnings report. You need to see data from a full cycle, including a really bad downturn.
So buying one of these means you've mistaken good recent news for a real structural margin of safety.
And when the cycle turns, they fall first and they fall hardest. The veneer of safety just evaporates right when you need it most.
So the rule for a defensive investor is to ask a really tough question before buying anything.
Yes, you have to ask, has this business proven, over a full cycle that included a recession, that it can comfortably meet its obligations and stay profitable?
And if the honest answer is, well, we only have data from the last 3 years of this boom,
Then it fails the test. It has to be ruled out for a defensive investor. The lack of proof of survival means there's no demonstrated margin of safety, no matter how good the story sounds.
okay, this brings us to the big one. The biggest temptation, growth stocks. The argument is always, why worry about valuation when a company can just grow out of the problem?
And the danger is that the price you pay for growth doesn't reflect a temporary problem. It reflects perfection. It bakes in these rosy forecasts for years and years, leaving zero room for error, for competition, for anything to go wrong.
Graham's rule for this was simple. Whenever you're estimating future earnings that are way different from the past, always lean toward the pessimistic side. Assume things will be harder than they look.
Right. So the definition of margin of safety has to be the same, even for a great growth company. The price you pay has to be low enough that even if growth is way slower than you hope, you still get a satisfactory return. It has to work, even if you're wrong.
So let's compare two scenarios. A good company that's been growing at 15% a year, and you think it can keep growing at 10%.
Okay, scenario one. The market is hot. You pay 30 or 40 times earnings. What you're really doing is betting on flawless 10% growth for a decade. If it slows to 7% or interest rates go up, the valuation just collapses. You've got no margin for error.
And scenario two.
Scenario two, you wait. You insist on buying that same great company for, say, 12 to 15 times its normal earnings. Now, even if growth slows down to 7%, your low purchase price already gives you a pretty attractive return from the earnings yield alone, plus whatever growth you get on top.
That is the difference. The skill isn't just picking the winner, it's insisting on a price that lets you be wrong and still do okay.
And Graham's final take on this is, it's a bit of a reality check. He said if the average price for all growth stocks is just too high, then a simple strategy of just buying a bunch of them won't work. To win in that environment, you need almost prophetic judgment to pick the very few that are priced correctly.
And since most of us are not prophets,
Humility is your best friend. If you want growth exposure, use a broad, diversified fund. Just avoid the huge mistake of paying a heroic price for one single story that can't afford a single misstep.
so let's pivot now to the other side of the coin, classic value or bargain securities. This is where Graham really lived. Here, the margin of safety is much more obvious.
Oh, absolutely. It's that quantifiable, favorable gap between the market price and your super conservative calculation of what the assets are worth.
And these are not the exciting companies. They're often dull, cyclical, maybe in some kind of distress. The appeal isn't the story, it's just the math.
Think about the classic Graham bargains, the net-net, where a company is trading for 2/3 of its net working capital, so cash and inventory minus all its debt. The price is literally less than the collectible assets.
Or a company rich in real estate trading for half of what its factories and land are actually worth.
In those extreme cases, the investor has this powerful protection. Even if earnings just fall off a cliff for a few years, that deep discount to asset value minimizes your risk of a permanent loss and pretty much ensures an acceptable return when the discount finally closes.
Let's go back to that real estate bond story from the Great Depression because it illustrates this so well.
It's a perfect example. In the 1920s, these bonds were sold as safe investments. Then the crash hit, they defaulted, and the prices just collapsed, sometimes to less than 10 cents on the dollar.
And the common wisdom at the time was that they were just speculative junk. Stay away.
Exactly. But the intelligent analyst, the one who actually did the work and valued the underlying buildings, often found that the property was still worth, say, 40 or 50 cents on the dollar. The collateral was still there. It was the market's perception that it collapsed.
So the disciplined investor could buy at 10 or 15 cents, knowing it was backed by 50 cents of hard assets. That massive gap was the margin of safety.
And when those bonds were eventually reorganized and investors made 3 or 4 times their money, the world called them speculative profits. Graham hated that. He said they were the earned reward for intelligent, conservative investing based on facts, not on hope.
Which is why the label on a security, whether it's called a bond or junk or growth, it's irrelevant.
Totally irrelevant.
Yeah.
The only thing that matters is whether or not there is a quantifiable margin of safety. That's what separates investment from speculation.
And this even applies to more complex things like mergers or spin-offs.
Yes, the special situations. If your analysis shows the likely payoff is comfortably higher than the price you're paying, and you spread your bets across a bunch of these situations, you're maintaining a margin of safety.
But that really requires an enterprising investor, someone willing to do the hard, non-consensus work, act when the numbers are right, and diversify so that one bad bet doesn't sink the ship.
Right. And that brings us to the critical role of diversification. It's not optional. It's a core part of the whole framework.
So how does spreading your risk actually make each individual investment safer?
Well, think of it this way. Every investment you make with a real margin of safety is a bet where the odds are tilted in your favor. But even a great bet can fail because of some random, unknowable risk of fraud, a sudden regulatory change. Diversification is the mathematical tool that ensures that the overall result of all your favorable bets becomes predictable and reliable.
The roulette wheel analogy is perfect here. On a normal roulette table, the house has a small negative edge because of the 0 and double 0. The payoff is a little less than the true odds.
Right, so if you play more and more numbers, you are mathematically guaranteed to lose more money over time. In that case, diversification actually makes your loss more certain.
But now, imagine a special casino where they raise the payout so the player has a small positive edge.
The logic just flips completely. With a positive edge, you should play as many numbers as you can, as often as you can. The more you play, the more certain it is that you will profit over time. A positive edge mathematically demands diversification to work.
And investing with a margin of safety is exactly that. You're trying to run your own little casino, seeking out lots of small independent positions where the math gives you that positive expectation.
This is why Graham was so insistent that even bargain hunters needed 20 or 30 different stocks. The bargain price gives you the edge, and diversification ensures that the profits from your winners will reliably overwhelm the losses from your inevitable failures.
And for the purely defensive investor, it's the same idea in a simpler form. Just diversifying across index funds, global stocks, high-grade bonds, that's applying the margin of safety. You're guaranteeing that one company's failure can't ruin your whole plan.
Right. But it's not just about the numbers. Graham also elevated this into a kind of philosophical and behavioral requirement. He believed the line between investing and speculating had to be based on measurable evidence.
Yeah, the speculator is always relying on subjective things. Their gut instinct, market timing, a good story, or that classic dangerous phrase, "This time is different."
And the danger is that none of that is measurable. It's all based on high confidence, not objective facts. And confidence is very easy to manufacture, especially in a bull market.
Graham's rule, on the other hand, is very stern. An operation is only an investment if it includes a margin of safety that can be shown with cold, hard figures, supported by careful reasoning, and validated by real-world experience.
It doesn't guarantee you'll make a profit on every single pick, but what it does, and this is more important, is it limits your downside to something you can actually afford to lose emotionally and financially. It manages the risk of ruin.
And modern behavioral science, like the work of Daniel Kahneman, really backs this up. This idea of well-calibrated confidence and anticipated regret. You have to ask yourself, have I really thought through how I'm going to feel and act if I'm completely wrong about this?
So before you commit any capital, the margin of safety framework really demands you ask yourself 4 very blunt questions.
Okay, question 1. How much real personal experience do I have with this exact type of decision? And when I've made similar bets, was I right for the right reasons, or did I just get lucky? It's so easy to confuse the two.
Question 2. Zoom out. What's the general track record for this type of activity? What's the historical success rate for day trading or for chasing hot IPOs? If the success rate for almost everyone who tries it is terrible, why should you assume you'll be the one exception?
Question 3, the counterparty question. I love this one. If I'm buying this stock at this high price, someone else is selling it to me. What are the odds that I know something important that they don't? If you're just trading on news everyone has read, the answer is probably 0.
And the final, most critical question.
Oh.
If this whole idea goes horribly wrong, What is the maximum amount of money I could lose, and will that loss change my life or push me into panic selling at the worst possible moment?
The margin of safety, then, is a structure you build before you invest. It forces you to size your positions and diversify so that even your future panic self can't do catastrophic damage to your wealth.
This leads to one last philosophical idea, which is Pascal's wager. It applies brilliantly to finance.
Pascal's insight was that when you can't know the probability of something, you have to let the consequences of being wrong drive your decision.
Exactly. Applied to investing, it means you accept you can't predict the next pandemic or the next war. Therefore, you must never, ever arrange your finances so that one mistake or one macro event can completely wipe you out.
So the margin of safety is just taking the safe side of Pascal's wager. You give up a little bit of the boom time excitement to guarantee your survival when the bad times come.
And we saw the opposite of that in every bubble. People concentrating all their money in a few fashionable stocks. They were making a reckless wager, assuming the consequences of being wrong were survivable or that the probability of being wrong was zero.
Your goal has to be the opposite. Assume you will be wrong sometimes, and then arrange your portfolio so that when you are, it hurts your ego a lot more than it hurts your net worth.
And Graham boils all of this down into 4 simple business-like rules. They sound a little boring, but they are the keys to long-term success.
Okay, rule 1, know what you're doing. If you want returns better than a savings account, you have to know as much about the true value of your securities as a business owner knows about her own inventory.
The practical application of that is if you pick stocks, you have to be able to explain to a skeptical friend what the business does, how it makes money, why the price you paid has a margin of safety, and exactly what would prove your thesis wrong. If you can't do that, you're speculating.
Rule 2, intelligent monitoring of others. If you give your money to an advisor, you have to be able to monitor them intelligently. You need real, evidence-based trust in their skill and their integrity.
Right. You have to look past the marketing. What is their actual process? How do they define margin of safety? Are their incentives aligned with your long-term goals, or are they just paid together assets? You have to monitor the process.
Rule 3, fair chance of reasonable profit. Never get into any operation unless a sober calculation shows a fair chance of a reasonable profit. You have to avoid situations with little to gain and a whole lot to lose.
This is a great filter for complex financial products. If it's highly leveraged, totally opaque, or promises crazy high yields with no explanation, it almost always fails this common sense rule.
And finally, rule 4, courage of conviction. After you've done all the hard work, you've built the knowledge, you've ensured the price is right, you've diversified, then and only then have the courage of your convictions. Act on the facts, even if the crowd thinks you're crazy.
But the sequence there is so important. Courage comes last. It comes after the margin of safety is built. Courage without that foundation is just reckless bravado.
Graham closes the chapter with a maxim that should really guide every defensive investor. Achieving satisfactory investment results is actually much easier than most people think, but achieving superior results is dramatically harder than it looks.
And that's really the good news here. You don't need to be a prophet. You don't need to time the market or forecast recessions.
You just need the quiet, unflinching discipline to insist on a margin of safety. In the prices you pay, the balance sheets you accept, the diversification you maintain, and most importantly, in how you manage your own emotions.
That quiet discipline is what lets you stay invested through the full cycle, capture the growth that comes over time, and maybe most importantly, maintain your peace of mind when the headlines get loud and scary.
So let's wrap up this foundational deep dive. We've covered the margin of safety across bonds, stocks, growth, bargains, diversification, and even the psychology behind it.
And we're really curious to hear from you. Where in your own portfolio do you feel you have a real demonstrable margin of safety? And where, if you're being honest, might you be relying a bit more on optimism than on arithmetic?
Drop your thoughts and your questions in the comments below, and let us know what other fundamental concept from The Intelligent Investor or another classic you'd like us to take on next.
If you found this useful, please subscribe to Capital Allocation Lab and hit that like button. It really helps more long-term owners discover these episodes and supports us in keeping this content rigorous and educational.
Our mission is simple: to help you become a more disciplined long-term investor by revisiting and translating the greatest ideas in finance for today.
Thanks for joining us.
Thanks for listening to Capital Allocation Lab.
Until next time, protect your margin of safety and let compounding do the heavy lifting.